Americans are buying stocks thinking everything's fine. And the foreigners are going, you guys are screwed. We're buying gold. If you create a debt bubble, you only have two choices. You either pay it back or it's going to blow up. And we're not going to pay it back, so it's going to blow up. That's what's happening right now. We're in the process of the debt bubble blowing up. We can't afford our debt anymore. So the creditors are basically rug pulling us right now, but nobody's paying attention. Who are our creditors? Our creditors are foreigners. They buy the debt. And if the creditors go, I don't want your stinking debt anymore, then that's it. It's game over.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.
Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend Don Durrett from goldstockdata.com. Don, thank you so much for joining us today.
Yeah, Elijah, thanks for having me back on.
Well, it's great to have you today. Exciting days. I mean, we just had the highest quarterly close ever for silver, the greatest increase we've ever seen, net increase we've ever seen in one quarter. And now we're closing above $48 on silver spot ask. So your perspective on where we are right now in the silver market?
Yeah, it's definitely a fun time to do an interview like this. So today we had Friday close. We had gold closed at $38.83 spot, so almost $3,900 spot, up over $100 for the week. Silver closed at $47.88, almost $48. Those are definitely the highest weekly closes ever for you. I mean, cycle high for silver, all-time high for gold. And the HUI at 620. For the year to date, we have gold up 48%. We have silver up 65%. We have the HUI up 114%. So those are some stunning numbers. We're looking at historical stuff here. I mean, 65% movement in 1 year. I mean, and we're not even done yet. Pretty amazing stuff here. But the thing that's amazing is that we still haven't really begun yet, because in my opinion, we still have the most important facet for gold and silver miners is a fear trade. So the only time historically that the miners have done well is when investors didn't really have a choice. They couldn't make money in stocks, so they went to the miners. Best example is the 1930s. Gold stake mining was the number one performer. And then the 1970s, the miners did unbelievably well in the 70s because the stock market did poorly. And then from 2001 to 2011. So historically, the miners do exceedingly well when the stock market is not doing well. Well, guess what? The stock market today closed at a weekly all-time high. So it's like, what the hell's going on here? This is not when gold is supposed to shine. Gold is not supposed to be shining when the stock market is doing well. They're opposites. Gold is a hedge for uncertainty. The stock market, when the stock market is an all-time high, that means there's low uncertainty, right? The VIX is down, 17. It's like there's no fear, there's no unawareness. What the heck is gold doing so high here? So my point is that, yeah, we got the HUI up 100%. We got GDX, I don't know, up 130%, 140% for the year, probably 130. So we're seeing this unbelievable performance, but believe it or not, it's potentially just starting. I think it is just starting. I think the HUI is going to somewhere between 1,500 and 2,000. So it's at 6,000 right now. So it'll double. I don't think it'll double again after that. But I think it might come close. Um, but my point is we're early innings here still. I'm still waiting patiently for the stock market to stop going higher. That's when we win. We win when we're the only game in town. That's when, basically all the assets are going down. Your house is going down. The stock market is going down. Even bonds are going down. The only thing that's going up is gold and possibly silver and Bitcoin. Those are probably the only assets that are going higher, and everything else is going lower. We're getting close to for that pivot. I've been waiting for that pivot for more than a year, maybe 2 years, waiting for that pivot where the markets go down and gold goes up, that kind of decoupling. So we've had gold and the stock market correlated since March of last year. So 18 months of strong correlation, which is kind of weird. The gold basically took off in February 24, and it just hasn't looked back. I mean, we didn't retest 2,000. We didn't retest 3,000. We did not retest those levels. We have not retested 40. I don't know if we will. I think we will, but we might not. I do think that we're going to get a correction in gold, and when the stock market finally goes down. One point I want to make here is that I don't think that gold and silver are going to correct on their own without the stock market. Everybody's saying, well, these miners, RSIs are through the roof. They have to correct. I'm getting out of here. I'm trading. I'm taking profits. And the gold's been correlated to the stock market. So I don't see gold and silver correcting just because they made these big runs. I think it's going to take the stock market to correct before gold corrects. So if the stock market doesn't correct this month in October, we could easily go above $50 in silver. And that would take us, 75% up for the year. And gold could easily go above 4,000. That would take gold above 50% for the year. And the HUI, 650 or higher before this thing finally does correct. I mean, that's what I would like to see. The higher that we get, the better for us as investors, because then when we correct back down, we have a lot of room for error, if you will. I mean, if the stock market, I wrote today in my Friday night recap that I think that the correction is only going to be 25% for our stock. So that'd be about a 12% correction in gold. That's kind of like worst case. That's really not much. In 2008, my portfolio went down 70%. And I think the HUI went down 70%. We had a mega crash in the miners in gold and silver in 2008. I'm not expecting that. That's a severe correction. For me, I'm thinking 20 in 2025 is about as deep as we're going to go. And as far as I'm concerned, that's a nothing burger. And the reason why it's a nothing burger is because it's going to be short-lived. If we're in a bull market, and I think we are, in gold and silver and the miners, if you're in a bull market, when you get a correction, it's usually followed by a bounce and a new high. That's what a bull market is. So I'm not really worried about a correction here. I'm just, as far as I'm concerned, ride the train and buy the dip.
One of the things that's been impressive to me is when we have seen a pullback in gold and silver, it just bounces right back. Just like we saw yesterday on Thursday, like $2 down for silver within 2 hours. It was insane, but now we're already back above the levels that it dropped from. And I mean, that must just show incredible strength in the market. And as you're saying, it's not even like we're seeing stock market weakness at the moment. So we're seeing the strength even before really things have started.
This bounce that we had today where, silver was up, I don't know, it was up $2. And gold was up today, I don't know, $50. This is what we've seen over and over again for the last 18 months. Whenever gold has went down, so we were in this range, this tight range. Gold was in this tight range, and it created this flag where it just recently broke out at 3,700. But it was in this tight range of, I think, 3,300 to 3,500, but it was in a tight range for several months in a row. And every time it went to the bottom of that range, it would just turn around and go back up to the top of the range. It was like, go to the bottom, go back to the top. In other words, it was following the stock market. So gold would go down a little bit, but then the stock market would go back up, and gold would say, "Oh, you're going up. Okay, here I'll come follow you." And then gold would go down, the stock market would go up, and oh, okay, here you go. So gold has been following the stock market up, but outperforming it in a big way. I think stock market's probably up 15% for the year. It was up 13, maybe 14% for the year, somewhere there. I think it's a little above 13. But gold's up 45, 47 for the year. So gold is the leader here, not the stock market. Gold's the leader. And so even though it's following the stock market higher, because the stock market just keeps making all-time highs, gold not only follows it, but it exceeds it in a significant manner. But gold's the leader here. And the reason why I love gold and silver so much is why. I mean, the reason why gold is the leader this year is because Triffin's dilemma is playing out. This is all about Triffin's dilemma. This is the reason why I've been a gold investor for all these years, is that, you know, I go back to George Bush Sr. when he called, you know, Reagan's economic plan voodoo economics. And he was really a lone voice. When he said that, when he said voodoo economics, nobody else had said that. Nobody else had attacked Reagan. No economist, nobody really attacked him that I was aware of. It was kind of out of left field, but it was spot on. It was absolutely spot on. You can't live on debt. And that's what the U.S. has been trying to do since the 1980s. And now it's become, you know, it really picked up speed after the 1990s. In 2001 forward, the debt explosion began. So you had debt explosion number one was in 1980. So Reagan came into office. Our national debt was under $1 trillion. He leaves office and it was 2.7. He just, you know, pedal to the metal. And then in 2000, I think the national debt was about 5 or 6 trillion. And today it's 38, 37. And so it's just been going higher and higher and higher. And so since 2000, and this, you know, it's just Triffin's dilemma playing itself out. I mean, once you start living off debt, you're going down a slippery slope. So starting in 2000, we started averaging 8% annual debt increases, 8%. Well, you can't have 8% GDP. There's no way in hell, right? So we've been living on 8% annual debt expansion. Now, you have to ask yourself why. Why do we need 8% annual debt expansion? Well, guess why? It's because we're not generating any wealth. So we need the debt to stimulate the economy to create 2 to 3% GDP. So we're living on debt. And that's the voodoo economics that Bush was talking about, that everybody ignored, and to this day they ignore it. Nobody's really talking about the debt bubble except for people like me, you know, the alt media, you know, the people on the podcast. But you don't hear about the debt bubble. Like, I watch CNBC's halftime show and Closing Bell. You never hear the word debt bubble. Maybe they might mention the budget deficit once a month, but they never mention debt bubble or debt crisis. That might come up maybe on the Closing Bell by a few analysts, but by and large, it's kind of ignored by most of the analysts. And that's the reason why gold's going up. And that's the reason it's going to continue going up, because Triffin's dilemma is playing out. And there's nothing, at a certain point, there's nothing you can do to stop it. You get in a doom loop. Once your debt gets to a certain level, you get into a doom loop. And no matter what you do, it just gets worse. So right now, for instance, the perfect example, it was the big, beautiful bill, right? There's no way in hell Trump wanted to do that bill. He just had no choice. If it was his choice, he would have balanced the budget, right? He would have balanced the budget, but he couldn't. He had to basically have a $2 trillion deficit, because if he didn't, the economy would go into recession. It's called fiscal dominance. You're locked in to spending money, because if you don't spend money, then the economy crashes. So it's like, and he's like, okay, well, then at least I'll try to raise some revenue through tariffs, which is an act of desperation. And it's negative on the economy. Tariffs are not positive. They're not. They're net negative, because it's basically a tax. Someone's got to pay it. It's not a free pass. That money's going to the government. And how is the money collecting it, right? And so Triffin's dilemma is playing itself out. And Triffin's dilemma, and just to define it really fast, was just this idea that if you have, he basically said the US is screwed because you guys have the reserve currency. And if you have the reserve currency, that's not good. That's bad, because what it does is it ends up hollowing out your economy because you can't compete. It's basically all about the transfer of payments and interest rates and in your currency. And there's nothing you can do about it, because your currency is going to be the strongest currency because you are the reserve currency. That's it in a nutshell. You're going to have the strongest currency because everybody needs to buy it. You got this big advantage. It appears that you have an advantage over the rest of the world, but in actuality, it's a net negative because it hollows out your economy. It's like a cancer. It's like you're eating something that's just going to kill you. It's just, you're just playing with fire. And that's what the US has been doing since the 1980s. We've been playing with fire. And now it's caught up with us. And that's why gold is at $3,800 and keeps going higher, because gold's going, you guys are screwed. There's nothing you can do to fix this. There's only one solution, which von Mises clearly pointed out. He basically said, look, if you create a debt bubble, you only have two choices. You either pay it back or it's going to blow up. And we're not going to pay it back, so it's going to blow up. And that's what's happening right now. We're in the process of the debt bubble blowing up, and we can't afford our debt anymore. So the creditors are basically rug pulling us right now, but nobody's paying attention. Who are our creditors? Our creditors are foreigners. They buy the debt. And if the creditors go, I don't want your stinking debt anymore, then that's it. It's game over.
You mentioned how the debt crisis is really the reason that gold is rising so dramatically right now. And getting back to what you were saying at the beginning of this interview, it's not like people are moving to it as a safe haven, as opposed to, that they're running or scared at the moment because of the economy or the stock market crashing or something like that. It's an interesting dynamic here where people are still piling into the stock market, so they must not be too concerned about the future. But then maybe the insiders are playing their hand more wisely, right, and moving into hard assets. What do you think the dynamic is here?
It's fascinating. So the buyers of gold are not Americans and not the U.S. central bank. The buyers of gold is foreign central banks, foreigners. Foreigners are buying the gold. Foreigners are pushing the gold up, not Americans. Americans are buying stocks thinking everything's fine. And the foreigners are going, you guys are screwed. We're buying gold. I mean, that's kind of what the story is. The story is foreigners are basically saying the U.S. is in a big, big problem. And there's no way they can get out of it. And we're going to buy gold because see, what's happened is that we have been on a dollar standard, I think since 1945, right in there. We're on a dollar standard. And so that dollar standard has forced international countries to basically assume U.S. assets, dollars and bonds. So what's been happening is foreigners have been de-risking themselves by selling those dollars and selling those bonds and buying gold. That's what's happening. Central banks are basically, these are all central banks all over the world. They bought 50 tons, I believe, in August. So 50 times ton, that's 600, tons a year. And so they're buying gold and selling their bonds or selling their dollars. When they buy gold, they buy the gold with dollars. And so that's what's happening. It's foreigners recognizing Triffin's dilemma and getting away from these U.S. assets, recognizing that there's a transition coming. I don't want those stinking dollars anymore. I don't want those stinking U.S. bonds anymore. I want gold instead. They're basically front running the crash, if you will. The U.S. consumer, the average U.S. consumer doesn't own any gold. I think the average one has less than 1% of their net wealth in gold. It's less than 1%. It's tiny, tiny, tiny. And that's the average. So maybe most people have zero gold, don't have any, right? And the average is less than 1%. And so it's really foreigners that are pushing the gold price up, not Americans. But that'll change. That's when the fear trade comes in. And then when the fear trade comes in, then the Americans will start buying gold. They haven't started yet, but that's coming. We're seeing a lot of people say things that we've never heard them say before. as far around gold. We're seeing some banks basically saying, look, you need to have, we've basically saw somebody say 60-20-20, where you need 60% stocks, 20% in bonds, 20% gold. 20%. I mean, I never thought I'd ever hear a bank recommend that their clients have 20% in gold. Are you kidding me? The average American's like, 20% in gold? Are you out of your mind? I mean, it's like, no way in hell I'm going to do 20% in gold. That's the mentality in America today. It'll change. They're basically just giving everybody a heads up. You might think about 20% in gold. That's what Triffin's dilemma is kind of pushing us toward. Is pushing us toward accumulating gold and silver as people become more recognized. And because the end game here is a reset. And the reset is going to be a devaluing of the dollar. That's the reset. And if we devalue the dollar, guess who wins? Gold. That's how you front run the reset. You buy gold. You protect yourself. You protect your capital. That's what gold's about. Gold isn't about making money, except for in the mining stocks. Gold is all about capital appreciation. So when they say get 20% of gold, they're basically just saying, just use that for defense for your other 80%.
It is an interesting dynamic, as you point out, how it seems like almost nobody in the U.S. is invested in gold. And as we've seen this, I guess, run up in the price, gold and silver both doubling over the last 2 years or so, some people might be wondering, well, are we near a top, right? It seems like things are getting a bit frothy here. As you mentioned, the RSI being at crazy levels for gold and silver. But when you look at it, what are some of the indicators? I mean, you've gone over them, how it's really, the public is not jumping in yet. But what are some of the indicators showing that, we're not at a top at the moment? And this isn't a situation like, for example, in 2011, when silver crashed and gold crashed as well. What are kind of indicators are showing you that that's not the kind of environment we're in?
Right. So I'm somebody who does this very holistically. So that would be something I'm definitely looking for, right? Like, what are kind of the potential market tops? And so one of the things you want to look at is history, what gold and silver has done historically, and then the charts, the current charts. And so if we look at history, we look at the bottom of the cycle in 1971, 1980, we went from $35 gold to $850. So I mean, 20x. I mean, gold went absolutely bonkers in that one, right? But that was artificial because we started at $35 gold, which it was kind of misleading. You can't really use that one there. But the next one I think is very valid, which was 2001. We were $250 gold, and we went to 1935, which is about 8x. And I think 8x is probably a pretty good number to use, right? And we went up 8x so far? No, we haven't. So this particular cycle, plus these bull markets usually last about 10 years. Now, some people say that we should use 2016 as the beginning of the bull cycle because that was the bottom. I'm like, no, don't use the bottom. Use the breakout. So the breakout was in 2019. So if you throw 9 on that, it's 2028. So I think 2028 is probably a good year. So 27, I think we're fine. We don't have to really worry about it. This bull market ending, as long as history repeats itself. So those are the historical cycles. The other thing we can look at is the charts. So if you look at the charts will give you a kind of an indicator of how far up it's going to go. The charts actually use the bottoms. It's like you use the bottom of a cup, and then how far it went down, then how far it'll go back up. And so those cycles, people get some really crazy numbers. Really, really high levels, because if you look at the monthly silver chart, that was like the biggest bucket cup and handle you ever see. So silver, some people use some really crazy numbers of what silver can do based on the technicals. $100 silver, $50. These are just starting points about what silver potentially could do. I'm using $100 silver currently to value my silver miners. I've been using that since 2012. Most people have been making fun of me for years for using that number. Now, guess what? It's too conservative. That's usually what happens. You end up getting too conservative. I think 125 to 150 is a real pretty good target. I think 100 is becoming too conservative. Now, I don't think you should take profits. This is me personally, because I'm a speculator and I don't want to, give away my profits. But as far as I'm concerned, $4,500 gold is easy. So I'm like, I don't see any reason to take any profits till we get to 4,500. Now, if we get to 4,500 and gold is still in this very strong position, like right now, the wind's at the back of gold in a big way. I mean, and we're not even in a recession yet. The bond market really hasn't even become fragile yet. I mean, the strength of gold, the real strength of gold, really hasn't even kicked in yet. The strength of gold is when you realize that a reset's inevitable. We're not there yet. So the strength of gold is ahead of us. So let's wait. The way I've been saying is let's wait to get to $4,500 gold. It's a nice little round number. And let's reassess it then. But my expectation is that I'm using $5,000 gold right now to value miners, and I think it's way too conservative. I think 5,500. I think 125 silver and $5,500 gold is probably a better number. And so I'm going to have to change my prices pretty soon on my website. I think those are better numbers. I think we're going to hit those numbers. But I'll be selling most of my miners from 500 to 5,500 is my expectation. And probably 4,800, 4,700 right in there, I'll probably start selling. Maybe at 4,500, but maybe not. But definitely 5,000 to 5,500. Now I'll be exiting, I believe, early, because I think there's a very good chance that gold goes to 6, 7, 8,000. I think there's a very good chance that could happen, but I'm going to miss all that upside. And the reason why I'm going to miss it is because I've been doing this for a long time. I can leave early because I got in early. I've been collecting these things since 2004. Just building my portfolio, waiting for this event, which is about to happen, which is this reset that I've always thought was inevitable. Because again, voodoo economics, you can't live on debt. So it's just a matter of when. So, okay, I'll just wait for it. That's been my philosophy. Buy gold, silver miners, and just wait. And buy quality ones, I've had 20 years to basically figure out which ones to buy. So I've gotten really good at it. That's a long time. But as far as identifying tops, that's really difficult. But what you can do is you can pick a top in advance. That's what I've done. 4,500 to 5,500. So 5,500 is my top. I picked them. You could pick 6,000. You could pick 7,000. Pick a top and then sell to it. That is, I think, a really good strategy. Instead of just waiting until he gets there, I think you should sell along the way.
I think that's really good insights there with regard to kind of, I guess, keeping your emotions out of it, right? Which is really important when things can go vertical, as some people would say. At least the movements we've seen recently have been very dramatic, and some of us can, maybe our emotions can get involved, and that's obviously not a good thing. When it comes to, you're saying selling precious metal miners and stuff at these certain levels, a lot of people might say, well, for what, right? You don't want to hold your wealth in dollars if the dollar's being inflated away. So what is your perspective on that moving into other assets? What kind of assets will you be looking for at that time?
I don't know yet. I have a lot of possibilities, but until the time comes, until I actually pull the trigger, I'm not sure. One thing would definitely be certain. I will definitely buy physical gold. I mean, that's a kind of a no-brainer, because I'll be trying to maintain my asset, my capital. I won't be trying to make more money per se. So gold is a really good place to hide, if you will. So that's really the only one for sure. The other one is fiat. I probably buy like 3 different currencies. Like the Swiss franc is definitely one. I might go with the euro. Might go with the Canadian dollar since it's my neighbor. But I'll probably put some money in multiple currencies, just because, right? Liquidity or whatever. But as far as other types of assets, I'm not sure yet. I have a bunch of possibilities. I want to go back to the emotion thing, which I think is important. So I've been a very disciplined investor. I take the emotion out of all my stocks because I learned really early on that I'm basically very emotional about it. I learned that through like trying to buy options, and I found that I'm just terrible at it. Because you have to have the right mindset. If you want to find out if you can trade stocks, just do some options. You'll learn real quickly if you're any good at it, if you're a good trader or not. And I found out it's not so much trading, it's the emotions, because once you buy an option, you have to figure out when to sell. It's like, okay, you're in the money now. How long do I go? Right? It gets really mind racking. And so, do I sell today? Do I sell tomorrow? You wake up every day. Do I sell now? It's a very trying thing, and it requires a lot of your energy. And so, I learned very early on that I do really well if I stay under like my pain point. So I found that if I do low allocations, I really don't care how the stock does. So I buy a stock, I have like a minimum level, and then I have like a pain point. And so if I stay in any high risk company, I just stay below my pain point. And if I'm below my pain point, I really don't care what that stock does. I mean, there's literally no emotion. Most days when the stock goes up, the stock market goes up or down, I don't feel it at all. There's absolutely zero emotion, because my portfolio is so spread out and so diversified. I talk about it in my book, how you create a foundation of high quality assets at the bottom of it, and you don't over allocate to high risk stocks. And so by me doing that, I've taken all the emotion out of it in my portfolio. What I've done is I've created an edge. So I want to go to bed thinking I got the advantage here. So the reason why I have the advantage is because if you get a good entry price on a mining stock, and the price, all you need is the price of gold to go up, you have an edge. Because all I need is the price of gold to go up and I make money. And it's basically a single variable. Now, that single variable doesn't mean that all my stocks are going to go up. It means the majority are going to go up. I don't need them all to win. I only need 80% to win and 20% to win really, really big. 20% can be poor performance. It won't hurt me at all. And so that's my edge. And so I created that edge through good stock picking, but allocation is really important. And my book really explains how to do this, how to basically create, an allocated portfolio. And I mainly do it by keeping my allocations low on high risk stocks. And so I'm going to do the same thing when I sell. When you sell, I've already done this for about 15 stocks. I already have exit points on about 15 stocks, and those exit points will grow. And so those exit points, they're already determined. And so I will get an email when those companies hit those exit points. I'll get an email, and there's no emotion there. I get the email, I go sell. And so I'm going to use the same discipline selling as I did buying. Take the emotion out of it. And so that's ironically, it's probably going to be harder to sell than to buy, because when I buy, it's pretty simple. You find a stock you like and you buy it at your minimum price, or you buy it at your pain level, or you buy it above your pain level because you really like it. It's really simple. Buying is actually really simple for me. It's all based on risk reward. But selling it will probably be a little bit harder, I think.
Certainly. And if our viewers are interested in learning more or checking out that book that you mentioned, we'll put a link in the description to goldstockdata.com, where they'll be able to find all of that. Did you have any last thoughts for our viewers? I know it's kind of as you mentioned, it can be an emotional time in the markets as we're seeing metals move here. But any last thoughts before we let you go regarding the gold and silver markets?
There's two ways to do it. One, you go to Amazon, search for my name. Second one, you go to my website, and it's on the main menu. It says book. So use one of those two. As far as final thoughts, a lot of people are wondering, should I get in now or should I wait for this correction that's coming? And I basically say you have to be on the train. Yeah, you definitely are going to get rug pulled, probably 20%. But we don't know if that 20% rug pull is going to happen now or if it's going to happen after we go up another 10%. So you pretty much need to, I think, get on the train, buy the dips. That's how bull markets work. But absolutely expect the dip. So you might want to save some powder for it. That's what I've done. I haven't saved powder for new stocks. I've saved powder for stocks I already own that I think I could use a little more I wouldn't mind having a little more allocation in. And so I'm like, okay, so those stocks, I'm like, okay, I'm gonna buy those on the dip. It'll lower my cost basis a little bit on a few of them, I think. Some of them, some of them my cost basis will actually go up because those stocks are up already. But I'll add some shares. So you kind of want to do that. One final thought I'm going to talk about physical gold and silver. I really believe, I'm a real big believer in stacking that. If you don't have any physical, buy a bar of each one and decide which one you prefer. Get some in your hands. You don't really know if you're going to be a stacker till you begin. But once you have a few bars, you're like, wow, this is real money. I want more of these. But if you haven't started stacking, I really recommend it. I don't think you should worry about $3,800 gold. That's not why you don't buy gold because it's high. You buy gold because it's gonna maintain its value. You're buying something that's gonna maintain its value. That's the reason you're buying it. So don't worry about the price per se. If it goes down, buy some more. But that's okay. So those are my closing thoughts. Elijah, thanks for having me on. We'll do this again sometime.
Well, it'd be great to have you on soon as we see all these this market play out. It's been quite interesting so far, and it should be for many months ahead and probably years ahead as well. So, Don, thank you so much for your time today, and God bless.
Thank you.
This is Kaiser Johnson with Liberty and Finance, and these are the Miles Franklin Weekly Specials for September 29th through October 6th, 2025, while supplies last. First this week, 1 ounce gold Philharmonics are just $75 over spot. Next, 90% silver US half dollars are just 69 cents over spot per ounce. And finally, the silver Australian Year of the Snake coin for 2025 is just $5.99 over spot. To order our specials or any of the many other options we have available, call us at 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you.